Can you give us a little bit of idea of how you view how a company should manage the cash that they keep on their financial statement?
Sure. Well, we always start with what's the purpose of the money. If it is like an operating line or an operating account that you're going to have to draw on, of course, you're going to have to stay very liquid, very safe. You don't need the volatility. You don't need anything locked up. So, there's pretty good rates on money market. There's good rates on treasuries. Just depends on the time frame mostly on those. If it's a longer purpose, say capital expenditure that's months out, or maybe the balance of an operating account that you're not going to draw down, some of those could be better invested longer term and match those time frames with the time frames of the use of the money. So maybe you could buy a longer term treasury or CD. Or
what I see with these clients is a lot of times they're going to say, I might need to buy something. I might need to buy something. And then they store more and more and more money. And then they might do a drawdown, but it's not all of it.
Right.
They might take 15% to 30% down, and then a year or two later, it's right back up.
Yep.
If you have somebody that's like that, what do you like to offer as alternatives to basic treasuries?
Well, again, everything keys off of the time frame, and if you're talking very short, treasuries are the best short term. Money markets are competitive too if you need daily liquidity, but beyond that, treasuries, CDs are good short term. If you get a little longer term,
I'm thinking, in all reality, the money will stick around for 2 to 3 years.
Yeah.
Maybe 4.
Okay. So if you get out in the 3 or 4 year, something like an agency bond, government agency bond, or mortgage-backed agencies where you can get an extra percent and a quarter for being willing to step 1 half notch down in security and maybe 2, 3, 4 years longer in maturity.
And you're buying individual bonds, right? You're not buying mutual funds or anything like that.
Right.
So in the worst case scenario, you just hold them to maturity and you get your money back.
Ideally, you hold them to maturity. And if we have enough time, we like to set up a bond ladder where you're buying maturities that are maybe 1 year apart or 6 months apart, or line it up with the need for the money. If you know when you're going to make that expenditure, line up the maturity of the bond with that.